options, there's generally, or there's two of them. One's going to be a call, and the other one's going to be a put. Okay. Now, before I even start explaining what those are, let me just kind of give you an analogy. Let's say, and again, I'm not a sports guy, but I just choose Dallas Cowboys because I played them for a video game a while ago, and I also know the New England Patriots. So let's just say we have the Cowboys and the Patriots. And we know the Patriots are a lot better than the Cowboys. At least I'm thinking that's what it is. And so I was going to say, let's take a bet on the Super Bowl. And we'll just say Connor says, I'm going for the Cowboys. So we'll put Connor right here. And I'll say, nope, I'm going with the Patriots. And Ken, being the good guy as he is, he's kind of like the middleman or the broker. And he said, okay, I'll facilitate this. So in regards to looking at the bet, it's kind of even because let's just say we don't know if the Cowboys or the Patriots are going to, we don't know their stats, I guess you would say. And so it's the first quarter of the Super Bowl. And so the Cowboys, 0, Patriots are now at 7. And let's just say the initial bet was for $25. Okay, so then we're going into, I'll put the halftime real quick, HT. But at the first, let's say we both bet $25. Now, for Connor, and Connor, if you want to even ask, you can even pitch in or not. If you were to bet with the Cowboys and I bet the Patriots, and you see the first quarter, the Patriots are 7 and the Cowboys are at 0, how do you think your bet's looking?
It's looking good.
But you're betting they're going to win.
Yes.
But the Cowboys are at 0.
Oh, you said I thought.
Oh,
okay,
yeah.
Other way around. Yeah. Not
so
good.
it's looking good for me. I'm going to make that $25. Okay. So essentially, Connor I can now say, well, do you want to renegotiate the bet? Now I know the Patriots are going to be are ahead, so it's looking better for me and worse for Connor. So we can then rechange that bet. I'll say, you know what? I'll cancel this bet. But I'll say if the Cowboys win, I'll pay you $10. But if the Cowboys win, you can get $30. And if the Patriots win, I'll take 15 instead. Because guess what? When I'm taking that bet, now yes, Connor will have to pay me less, but because Connor already knows that the Patriots are ahead. And then with the Cowboys, it's the chances of that are lower. Now, further on in the game, let's just say now it's the third quarter. So let's not even worry about halftime. It's now third quarter. Okay. Cowboys are at 15. Patriots are at 21. So, Connor, you still want to take this bet? You think the Cowboys are going to win?
How risky am I?
I don't know. It's third quarter, end of third quarter. So you've got one more quarter.
Let's just say, yeah, I'll take it.
Okay. All right. So we'll just keep the same bet just to not confuse you with all the numbers. Finally, it's now literally 1 minute till the end of the game. Cowboys are now at 28. I'm just throwing numbers out. Patriots are at 35. Okay. There's literally 1 minute left. Actually, let's even change it. Let's say it's 10 seconds. Connor, you still want to take a bet if the Patriots are going to win?
I sure don't.
No, you're not.
No.
Okay. So even though the analogy may seem a little weird, you're kind of thinking, where am I going with this? When we look at options, we look at it's a contract, okay? And so what is this contract? So when we look at options, it's the right to buy or sell a given stock at a certain time, okay? And the stock goes by 100 shares. I'm sorry, the option contract goes by 100 shares. So when you buy one options contract, you're technically purchasing 100 shares, so a contract for 100 shares, and you have the right to buy or sell at a certain time for a certain price. Certain time for a certain price. Okay, so when I'm looking into this, there are two types of options. There's a call, which that's the right to buy. Right to buy. And then there's a put, the right to sell. Okay, And so when we look at those, we think, well, why would I want to even purchase this type of security? What's this product? What does this do for me as an investor? Well, I know a lot of you have been following about NEO and also PLTR. How do you pronounce that? Palantir?
Palantir.
Palantir. Okay, I'm really bad at pronunciation, so I'm sure chat's probably like laughing at me and all that, but that's okay. So when you look at a stock and you think that the underlying stock price could technically go higher at a certain time period, then you would want to buy a call. Now, this isn't for everyone. You can just stick to buying your stocks and letting it go up, but there's also some advantages to buying these contracts, and we'll get into those in a second. Okay, and then with the put, that's the right to sell. So when you look at a put, if you think, oh man, this stock doesn't look good. So a good example would be J.C. Penney's and Macy's. Back in 2018, those companies, they were doing okay. But then as Amazon was becoming more competitive, as other places were determining, online ordering is kind of like, that's the new thing. You don't go, people go shopping, yes, but there's just more online ordering. So if you think, hey, this stock may go down, then I'll buy a put. So that's basically, I'm purchasing a contract to sell 100 shares of, stock ABC or whatever stock you want at a certain price. Okay, and so people may also wonder, well, why would I want to buy either of these anyways? Well, you can also look at these as insurance, and some people they don't really see it like that. So, for example, let's say you own 100 shares of Apple, and let's say, well, you would be in a larger firm that does this, but you have a lot of equity in Apple and you want to protect your asset, you pay insurance. Just like you buy a car, you have to pay insurance. And we'll talk about calls in a little bit as well, but just kind of give you an idea of those. So with that, are there any just initial questions? I don't have the chat pulled up. I should.
Yeah, so there is, and I'll tell them to you, and you can pull it up as well. A nice thing with Zoom, if you have multiple monitors, I don't know if people do, but you can pull the chat to another monitor.
Yeah, I just figured it out.
Yeah, that's super
okay.
nice.
Okay.
And then, so yeah, do you see that question so far?
Okay.
From Jason.
Okay. Yes. Yeah, so Jason asked, do I need to have cash on hand if my put fails? This is the confusion I constantly have. If a put goes up, if a put goes up, do I have to buy the? Okay. So I guess what I should do is first talk about kind of the details. The details of what an option is. So let's just pull up a real option, and let's dissect it. So yes, it says money due. I've jumped to every single broker. They've all marked me for pattern day trade. I'm back at Interactive Brokers, but I'm just looking at Schwab because I know a lot of people use Schwab. I'm going to go through how to place orders on Schwab, TD Ameritrade, and E-Trade. And then I know Ken is going to show how to use Webull. So what you want to do is, if you use Street Smart Edge, I don't know how your guys' accounts are set up, but I pulled up, when you go to trade, it will show, over here on your left side, stock, ETF, but then you'll also see calls, puts, conditional orders.
So before you jump into all this,
right,
to answer his question before you get too far away. But yeah.
Connection lost.
Yeah. So the question that we got was from Jason. Buying a put/call gives you the right, not the obligation. So
right. The right. Yes. Yeah. You don't have to. You do not have to fulfill the order unless you were to short the option or to sell it. Then that's different. If you get assigned, then you have to follow the contract obligation.
To chime in to kind of help with the confusion. So it's let's say when you write a call. So that's how at least how we would say it in the industry, is that you're writing. So none of hope to God. So if anyone it's not necessarily, it's a risky thing. So this is where I think most people are just asking about buying it. So, but with buying it, the thing that you have to make sure that you do on, say, Robinhood, I know at Merrill and Webull and a few other platforms, you have to select do not exercise at expiration. So there is an option on there that gives you that. So when you buy it, or you can look at it, it's on your window screen. It says, yeah, do not exercise, because if it does expire and you don't check that box off, it's going to force you to buy or sell 100 shares of YZ. So that's something to be cognizant of.
Right. Yes, and I know some brokers, they will look, the computers automatically look 1 hour before closing, and if you don't have the funds, it'll actually auto liquidate. I'm not sure with Schwab if it does that. I know Robinhood does it, which is weird in my own opinion. But I think other brokers do that as well. I never did a lot of the options calls. Ken, do you know if Merrill Lynch did that?
Yeah, Merrill Lynch was under the impression that they automatically just purchased it for you. So,
okay, so yes, so you have to be very careful with options. With the stock, you own that piece of the company, whereas an option contract, you own the contract, not the company. Or not part of the company. So when you look at calls or puts, it's the right, not the obligation. So you have the right to exercise it, and you can exercise it at any time. Most option traders will hold it until before expiration to get the most value, and I'll cover some of that a little bit later. But then also, because with options, it can be more profitable than buying 100 shares, because there's kind of that uncertainty with an option because it's still a contract. So let's say, for example, so I guess before I even go into here and dissecting this stuff, let me just make up something. So let's just say I'm going to buy one call. So that's the right to buy call, and I'll say ABC, okay, and I'll say $10 on January 21st, okay, and I'm not sure if that day even makes sense or not. 2121. Okay, so what this is stating is, when I look at this, it's a call, so I know that's a right to buy. So I'll just write RTB, right to buy, and I'm going to look at this stock ABC, and I can purchase it for $10, and it expires at this date. Okay, now let's kind of look at what this means. Okay, let's say right now stock ABC is trading at let's say it's $6.45. Okay, and what's the date today? 11/11. Make a wish. Okay, and so I purchased it. So this call contract was purchased. Oops. Purchased. Now I'm going to write it in the way that you'll see it, but I'm going to actually change it for you so you can see. So this means at 0.65. Okay. Now when you put in the order, you'll see it will actually say $65. Well, why is that? Okay. When you look at your options contracts, it will say a bid and an ask, which I'll explain that. But when you look at the price, remember, it's going by 100 stocks. So that contract is for 100 shares. Okay. So basically you're saying you want to buy stock ABC in 2 months for $10, but you're going to pay 65 cents extra. Let's just put it for layman's terms right now, 65 cents per share. So I'm paying 65 cents per share. But again, how many shares am I doing? I'm doing 100. Thank you. So really, when you look at these contracts, whatever you see the dollar value, you're going to multiply by 100. Okay, so 0.65 times, and again, I'm just doing very simple math stuff, just so everyone can see it. That's really $65. Okay, so and I'm just going to throw out some other examples so you guys can see the correlation. If I see another stock for 421, I'm sorry, an option for $4.21, that's really $4.21 times 100. So that's really $421 that you have to pay. Okay, and so that's the right to buy. So now you're thinking, Chris, what does this even mean? Okay, well, let's say it's December 24th, and stock ABC discovers Santa Claus. I do funny things. Okay, I don't know how you spell Santa Claus. Okay, and he gives stock ABC unlimited toys to sell. All right, so now, what do you think is going to happen to this stock? Oh my gosh, they have literally free, no pun intended, free stock of toys from Santa Claus, and so they're going to make a lot of money because they don't have to do any production. They've got Santa Claus, he's going to give this company all the stuff. So now their stock, so stock ABC shoots up to $100 instantly. But guess what? You have that contract. So unfortunately for the person that wrote that contract or sold that contract to you, that stinks for them, but it's good for you. Kind of like going back to the Super Bowl bet. I made the bet for the Patriots. I knew I was going to win. Well, unfortunately, on the other side, there's a winner and a loser for everything in the stock market. So now, guess what? You can buy that stock for $10. Now, you had to pay $65 to purchase them, but I would do that because then guess what you can do automatically the next day or the same day that you exercise that contract? You can sell those immediately. So in terms of the profit, you essentially, just roughly with quick maths, you made $89 per share on that. So if you wanted to do the math on that, so you sold the $100, and then you take away the $10 because you bought it for that, and then you take away the 65 cents. So when you actually add it up or you subtract it together, so that's what, 89.35. So you made 89 profit per share. Okay, and again, and if am I going too slow or too fast, Ken, Connor, anyone else, or do we kind of understand how the principle of just the call works? Because it gets a little bit more.
Yeah, I think we're doing a good pace. Does the group have any questions? I don't see anything coming in through the chat feed.
Yeah, if you have confusion that you want it to be cleared up, please let us know in chat. Tiffany just said newbie here. So to clarify, you have to pay for the price at the time of the purchase of the contract, but you have the right to execute the call put.
Yes, that's correct. Yeah, you put the money up front, just like you put the money up front with a stock. It's not a stock that you own. You own a contract. It's different.
Oh, and for layman's terms, you're paying the premium, which is that 65 cents times 100. So you're paying $6.50.
$65.
Or
Yeah. $65 to buy 100 shares. But then if the stock goes up, then guess what? You're in what's called ITM, or in the money. But I'm just showing just the general, just what a call is, because a lot of people on both the website, on the group, and also people that I talk to, they don't know exactly what they're doing when they say, oh, I bought a call, and they say, oh, it's this. But once you understand the basics and you get in depth with them, it makes things a little bit clearer to then make more advanced decisions on how you actually want to execute some day trades or some long-term trades at that. Now, with options.
Curtis,
What is the 10? Oh,
question. Sorry to interrupt. So he says, who determines the premium?
oh, okay. Who does determine that? That's actually a really good question. It is a very long, well, not really long, but it's a multivariable equation that's used. And so, how do people? Dang it! I need to learn how to type. How do people come up with premiums? Okay, there's a couple of things. There's what the date. I'm sorry, time till expiration. Oops, I am a horrible speller. Doctorate in awesome, but not spelling. That's not expiration. Is that expiration? No, expire.
Yeah.
Yeah. Okay. Time till expiration. The price of the contract. I'm sorry. The price of the stock to buy for the contract. Okay, also known as the strike price. Okay, and then also implied volatility. I am a horrible speller. I'm sorry, guys. Volatility. I swear I know how to spell.
Yeah. So, and somebody, while you're doing this, somebody also asked, what is the 10 in the example?
The 10. Oh, because this is what the stock. That's what your contract was at originally. Because your contract, your strike price was $10. So that's where the $10 came from. Because with an options contract, you still have to if you exercise the contract, you still have to purchase it at the price that you stated you're going to purchase. The contract goes both ways. That person has to hand over that stock, or the person has to purchase that stock essentially, and then they take the loss, but you get it at what would be the cost basis of $10. And so, oh yeah. Okay, I'll go in Theta and all that, Jason, just so you know. So now in regards to this, and again, I'm just going a little bit slower just so we can get everyone, on all within the same page. Theta gang, funny. Okay, so that was a call. Let me go with what a put is. So basically a put is all of this. It's just opposite. And so essentially I'm going to make a new one. Okay. So, and again, it's always hundreds. It's always 100 shares. So let's say we're going to still use stock ABC. Okay. So right now we're going to say stock ABC, that news of Santa Claus and all that jolly stuff, no pun intended with that. Still at $100, okay, on December 26th. Okay. Now let's just say Ken believes the stock price will fall after Christmas. No, let me do holiday season. Okay. So Ken buys a put with a strike price, right to sell, at, let's just say $90. Okay. And I'm doing these holidays on purpose because I just think it's funny. On March 17th. Okay. So what does this mean? Okay, and I'll highlight. Okay, so put, that's the right to sell. Okay, and then the strike price is at 90. So what it would look like is you would say buy to open, put, and I'll go into why I put buy to open because I saw on the group page that there were people accidentally doing the wrong orders. And so I'll go into that in a second. Okay, put of stock ABC at $90 at 0.9. I'm sorry, at 90 on 3/17/21 for $5.40. Okay. Now remember, you're not paying $5.40 because when you're looking at a put or a call, it's in hundreds, so, or 100. So technically, you purchased this put for $540. Okay, so you spent money of $540, and it's the right to sell that stock at $90. Well, why would I do this? Okay, well, if Ken let's go back. Ken thinks that the stock price is going to fall. Oops. Okay, so he thinks it's going to fall. He's right. So ABC is at $60. And let's just say it's in February. It's Valentine's Day. So more people are purchasing candy, not toys. Okay. So if I were to calculate that, and I'm doing this for a reason, just so you guys, Ken and Connor, so they can talk about break-even prices so they can see the math. So if I were to look at, well, what did this what did this put option do for me? Okay, well, I have the right to sell this stock for $90. So whoever sold this contract, they have to put up. They have to basically purchase purchase the stock for that for the price, but then I get to sell it for $90. So if I really wanted to look at the profit that I made from this, so I know I had I sell it at $90. Okay. But I had to pay my my premium, which was $5.40, and I'm going a little bit more basic now, just so you guys can know. So technically, I made a profit. I'm sorry, I purchased it at 60. I messed up on that. Sorry. Okay, so technically, my profit from there. So 90 minus 60 minus 540. Now, where did I get the 60 from? Because I still had that stock and it's trading at $60. So I don't get it for free. Nothing's for free. So I sell it. So technically, if you want to just look at the quick math, 90 minus 30, because I purchased, or I wanted to sell it at 90 and then the stock's trading at $60, it's technically I made $30 per stock. So 30 times 100, if you do the math, 30 times 100, okay, carry the zeros, that's $3,000. But then also you have to take into your premium. So you made roughly $2,500 if you were to exercise that contract. Okay. Are there any questions on that? Do you want me to go to a little bit more advanced?
So one of the questions that Tiffany had was like, if you do, she asked, I'm following now, thanks. And you have the option to do that until the expiration date. And what I kind of brought up is like, do most people exercise options or do they sell them?
The statistics by the Chicago Board of Options Exchange or Based Options Exchange, CBOE, whatever that stands for, the statistics, it's like 70% of the contracts expire worthless, which I'll explain what that means. And 20% are exercised at the date, and then 10% are exercised early. It's a really weird number. Okay. Now people are probably thinking, what does that mean? Expires worthless. Okay. So let's go back at this example right here. I bought a call for ABC at $10. None of this happened. Let's say they didn't discover Santa Claus. Santa Claus didn't give them any presents. Or any toys or presents for free. Their stock doesn't shoot up to 100. In fact, Ebenezer Scrooge stole all the stuff from them. I'm sorry, I was a teacher and a professor, so I do the stupid stuff. But so now let's say stock ABC is now at $4.32. So let's just think about this. I have a contract to buy ABC at $10, but ABC on the market is trading at $4.32. let's see. Do I want to exercise my contract? Do I want to pay $10 when I can buy literally twice as much on the market? Yeah, that doesn't sound smart. So if the date passes, if it hits January 21st, and this stock is not above $10 and it's not above your premium, why would you want to purchase that? It doesn't make any sense. So this would be what's called expiring worthless. Okay, I know it looks like a G. Okay, so this is what would be called the contract expires worthless. Well, what does worthless mean? Nothing. So you lost $65 in that trade. Okay.
Does that make sense to everybody? If something expires worthless, you lose what you paid for it.
So with a call, when you're doing a call, you're expecting the price to go up. Now, if it goes down, you're in the opposite direction, so you're going to lose money. Okay. Now you may think, okay, you purchase a call one day, and then the next day the stock goes down. You're not done. All right. It's not the end of the world unless it expires that day, and we'll go into that stuff as well. Okay. Now the put, it's the same thing. So remember, a put is the right to sell at a certain price. So if I go back to this example, and Ken, he buys this put, the right to sell, at 90. Well, let me just delete this real quick. Oops. Okay. So let's say the stock continues to go up. Santa Claus, it's like, they're like, you know what? Let's have the holiday season, every month now, because we just get unlimited toys. All right. So now ABC is at, that's a bad at. Okay. ABC is at $110. Oops. And I just realized I erased my put. Okay. And there's the put for $90. Okay. Now, if this, let's just say it's the end of the year for this put, and Ken bought this. Now, would you want to exercise your contract to sell at $90? No, that doesn't sound right, because you can technically sell it for $20 higher if you were to have purchased those shares. Okay. So this put would expire worthless, meaning it is no value. Okay. Now that's at the end of the expiration date. Okay, because there's some other math stuff that's involved that determines how an option price changes over time. Okay, so let me go into a little bit more technical stuff, and I'm actually going to screen capture. I'm just going to use Neo because everyone is talking about that. And I'm going to dissect this real quick. Oops, wrong button. No, wrong button again. Okay. There we go. That was loud. So when you buy an option, whether it's a call or a put, there are what they call them the Greeks, but really when I look at them, I only look at two things. Actually, I'm sorry, I look at three things. And that is, what's my break-even point, and what is my theta, and what's my delta. Well, I also look at time value as well. But when I look at my delta, delta means change in the math community. A lot of people know what delta means, but delta also means a similar concept to an option, and that means the change. Okay, so what does that mean? Let me actually select. Oh, it's been a minute since I've done this. Oops. So if you look at, let me zoom in on this. Oops. Oh, that's definitely not working the way that I want it to. Okay, that's weird. Okay, you know what? Sorry, I don't know why that's doing that. Screen capture. I don't know why the Zoom did not work.
Oh, actually, I just remembered why. So I'm sorry, I wasn't paying it. So what you got to do is stop screen sharing.
Okay.
And then reshare it and selecting that one. So you have to, and then, yep. So, and then you want to select screen share, and then you select that window or that application.
Oh, okay. What's the size on that? Can you see that okay?
This looks better.
Okay.
I personally wish it was a little bit bigger, but I think this is doable. Hopefully everyone else can see it as well.
Hold on, I'll manually change it, and there we go. Ooh, okay. I'm just changing it real quick, and I know I probably should have had all this loaded up, but there's just so much to do. And let me just get one strike so you can see just one and not be. Okay, perfect. Okay, so this is Neo. Oops. And what I did is I loaded up. Let's just look at the call, only the call. So we're not going to worry about the other parts. Okay, so I look at what's called my theta. I'm sorry, my delta, and it says 0.5722. Okay, now that may be like, oh my gosh, what the heck does that mean? Well, that just means for every dollar, that's how this option's going to change. So when I look at my options, you have a bid. Oh, that's weird. I don't know why I did that. Oh, bear with me, guys. Sorry. So you have your bid. So if you're trading stocks, you know your bid is what people are asking to buy it at. Midpoint, that may be a new thing for you to see. Then you have your ask, and your ask is what people want to sell it for. So the one thing with options that I always want people to understand, don't buy market, because with stocks, yeah, you can buy market and you'll be okay generally if the stock's trading at a couple pennies in between the bid and the ask. But when you look at, so this is Neo for January 15th, 2021. So this call is $44. So this is the right to buy at $44. But now here's the question is, how much of a premium are you paying if you were to buy at the bid? So this is 7.25. So remember, this is the call, right to buy, but now a call is in 100 shares, so you multiply this number by 100. So 7.25, oh, perfect. Okay, this is a little bit easier. So 7.25 times 100, so you're paying $725. Okay, now going back to what the delta means. For every dollar this goes up, this price is going to increase. Now again, everything, all the numbers you see except for IV, this is a percentage, and time value, those are not numbers. Those are different. But everything else is in increments of 100. So that means for every dollar Neo goes up, this call is going to increase $57 roughly. All right, because it gets more advanced than that, but I'm just going to give you just the general idea of what you can expect if you think, oh, well, what if Neo hit $50? Okay, so it increased by $6. So if the delta was if it went up $6, you would multiply that by, I'll just round it to 0.58. And when you do the math, let's just say it's 6 times 6. Generally, it's going to be $350 extra in your pocket. So you put $725 down, you almost made half of your money, which is neat. Okay. Now, what happens if it goes down? that's a general indicator of how much money you can lose if it loses a dollar. So if it was $725 and the delta is just, let's say, 0.5, and it goes down to 43, I know, okay, if it goes down a dollar, I'm going to be at $675, or 600, and if you were to actually calculate it, 57. So it'd be, $640, $47. Okay. The next thing to also look at is what's called your theta. These are the only two things. Now, this theta is low. Now, what does theta mean? That means decay. And what decay is just it is what it really means. It's something will dissolve over time, or it decays over time. So just like with the Super Bowl analogy, the closer you get to the expiration date, this theta is going to go up, meaning you're going to lose that much amount of money per day. Okay? And so what does that mean? That means if I were to buy this today at $725, nothing changes. So let's just say nothing, the price doesn't move, nothing happens. The next day, I'm going to lose, it says 0.0584. Remember, it's in by 100s. So you multiply this value by 100. How do I change color? Oh, here we go. So every day it's going to go down -$5.84. Okay. Are there any questions on?
Does that make sense to everybody? Is there questions? Nothing in chat that I see.
Hopefully, if this doesn't make sense, ask a question.
Yeah, and then here's one thing I'll send people to. I did find a Greek calculator that does the math for you guys easily. So I'll send it to you. I downloaded it on my phone. You do have to pay for it. So that's the downside, but there is a free version which just allows you to enter one strategy at a time. So if I think just for beginners, this is maybe something good. The Greek calculator, though, it's not always accurate because it doesn't allow you to input the theta, the delta, and IV, and etc. But it's fairly pretty close to the ballpark.
Okay, there was a question, is theta ever a positive value? No. It will always decay because the closer you get to expiration date, the less amount of money people are going to want to either put out to sell it or to buy it, because you kind of have an idea of where the stock is going to be at. Let me pull up a call. Let me pull up November 13th. Even deep. It will decay slower. So when you look at this, so I'll just do 8 strikes. How do I clear all drawings? Okay. So this is NEO again. I'm looking just at the calls, and my expiration date, or the day that this contract ends, is November 13th. So that's 2 days from now, because it's Wednesday. So this is Friday. So if I wanted to have the right to buy at $44, now NEO's trading at $43.88. So this is $44, and I'm just focusing on bid. I'll go into what a mid ask is when we want to place the trade, but let's just look at the bid. So if I bought this for 0.98, how about someone in chat tell me how much you paid for it? Someone that may just be learning this right now. So remember, it's in stocks of 100. So if it's 0.98, yeah.
0.98,
yep. Yeah. Yep, exactly. So it's technically $98 is what you're paying for it. Okay? So you're paying $98, the right to buy it at $44. So if NEO were to get up to $47, so you look at your delta, and if you look at it, the delta for $44 as of right now, it's $41. I'm sorry. Shoot, I said the answer on accident. It's $41.20. So technically each dollar this goes up for this day though, it's roughly $41 or 41 cents per stock. Okay. Now, if you look at it, when you look at just, and I'm just using NEO, it's at 43. It closed at $43.08, even though it says extended hours at $43.54. The further away you get from the actual price of the stock, if it's a call, it's going to be cheaper. But, and let me tell you what a lot of the newbie mistakes are, is someone thinks, oh, they look at these prices, they don't understand what the call means. They'll just see a number. Then they'll see what the bid is. Let's just say they understand what the bid means. They click the button, it says $33 they have to spend. Oh, perfect. I'll just spend $33. They don't know anything about this other stuff. Okay? Now, it's cheaper because the likelihood of NEO hitting to $47 by Friday is going to be a lot less than to compare to $44. That's why this call option is more expensive by 3 times than this. Okay? So that's why that's what can occur with this. Okay? Now, why are these ones more expensive? Okay, well, this is the right to buy it at $40, but the bid is $3.25. Its delta is 0.84. So what some people do, I would say first learn the basics before you do more of these strategies. But if you buy what's called in the money, ITM, so in the money means that the contract has passed, the contract price is a lot lower than what the actual stock price is, because the stock price is at $43. And again, I'm looking at this one right here. Let me use a different color. I'm looking at the 40. The stock is trading at $43. So this is what would be considered in the money. This is in the money. This is in the money. These are in the money. Okay. There's what's also called ATM, at the money, which means it's literally at the price. Now, there are some calls that do cents, but they go in increments of 50 cents. Everything is divisible by 4. I'm sorry, not by 4. It's easily divisible in a what's a PM?
I
see.
Yeah.
Oh, okay, gotcha.
Just what he asked is, he had a call that went up early in the morning, then down in the afternoon, the stock price was higher. Usually, if the stock price goes higher, your contract is worth more.
It could be time value. So there also is implied. So I'll talk about implied volatility and how that affects the stock price too, because that's likely what's going on with it.
Especially with earnings next week too. So.
Yeah. So now again, going back to what, so there's ITM, there's ATM. Not many people, I don't know, how many people use ATM? Connor, do you hear people say that?
Yeah.
Okay. And then there's OTM, which is out the money. And let me go to text. In the money, at the money, out the money. Okay. Now, if I look at puts, it's literally the best way to explain what a put is when I'm looking at this stuff is it's upside down. It's just everything is inversed. Okay. But before I go into to looking at the puts, I want to talk a little bit about IV. What IV means is implied volatility, which that is the probability. When you look at implied volatility, it's a financial equation that uses a lot of different equations within it to calculate certain things. So the best way to kind of explain it is it's kind of how much of the stock price can it fluctuate? Okay. An average IV or implied volatility for just a regular stock, nothing's going on. There's not any news about trade wars. There's not a presidential election, even though that doesn't really affect IV too much. But anything over roughly 40 to 60%, because this is a percentage. I don't know if I just turned my percentages off, but other brokers may have a percentage bar or a percentage icon next to these IVs. Anything higher than that, that means you're going to pay a higher premium. So you're paying a higher bid than what you may normally have paid if there wasn't anything going on. So as Ken was mentioning, there's earnings reports. So earning reports, there can be giant spikes. Either it's going super far up, super far down, or it may just stay at where it's at. With options, what I tell people, you're at a 33% chance of winning if you literally just look at the probabilities of what you're looking at. And what I mean by that is if you look at, why is this not working? Okay. Why do I mean 33%? Okay, let's say in some universe there's a three-sided die. Well, okay. You either have to be in the money for this contract to be worth it. What do I mean by that? Okay, if I were to buy, let me get rid of some of this stuff so I don't overwhelm everything. Okay, so what do I mean by that? Is let's just say I buy this one for 43. Look, it's at $43.08. NEO's becoming popular right now. There's a lot of hype. Yeah. Okay. So I pay $1.34 for this contract, the right to buy it at $43. Now, remember this price right here, that's reflected into, it's not reflected into this price. This is what's called your break-even point. And this can really help people decide if they want to enter a contract at a certain strike price. Okay, so my break even, and this has to end November 13th. So what do I mean by this? This stock literally needs to hit both my premium that I paid, which is $1.34 per stock. So I paid $134, but I still have to buy, I have the right to buy it at $43. So I need to figure out what my break even point is. So my break even point is my $43 plus my premium. So really, this stock needs to get at $44.34 to literally just break even. So this stock needs to get past this dollar. Okay, if it passes that dollar, you're good. I would probably sell it before then. But those get into more advanced strategies. But I'm just showing you how these contracts work. Okay, so that just kind of ties into what you're. Yes, yep, that's right. From Jonah. So it's $43 times 100 because you're buying the contract at $43 a share. Contracts are in 100s increments, so it's 43 times 100. That's if you were to execute the whole contract, though. But if I'm just looking at just the single stock, this is good for people starting out because you can kind of ask yourself, is NEO going to hit $44.34 in 2 days? It could. I'm not going to say it could or could not because it's kind of jumping around like a kangaroo in the last couple of days. I mean, some days it was at 45, now it's at 43. What was it at? Earlier it was all over the place. Okay, I'm just looking at it for my reference. Stick with penny stocks. Okay, now there are some rules for options because people may think, maybe I'll trade a penny stock for calls or puts. There's 5 requirements, and I'm just thinking of a couple of them off the top of my head. Is they have to be traded. They have to have a certain volume. It has to fall under in terms of how many people inside the company own shares, the percentage. Just to confirm, a $43 call will increase by $22 for every dollar increased. At 43, it will decrease. It'll every day. So if I were to purchase this today at $1.34, so $134, tomorrow, if nothing changed, this call lost $22. So on open tomorrow, this call that I bought for $1.34 lost $22. So it's now $112 instantly. Now, if it went up, your delta will always supersede, for the most part, your theta if it's going past the money, or if it's becoming in the money. Okay, but generally, when you buy a call, you're bullish, so you want it to go up. If you're buying a put, it's bearish. Okay, and all these principles, these all apply to puts, but I'll go over a put as well so you guys can see it, because calls and puts, even though they're right next to each other and they're the same, but they're inverted. Well, they're inverted. It's just good to see, in practice. Okay, now there's one other thing that I also want you to look at, is that's the implied volatility. Okay. Oops. Uh-oh. What did I do? Okay. With an IV like this, there can be an effect, what's called an IV crush. What does that mean? Okay. NEO has earnings next week, so this call it's not going to matter. But for next week, oops, give me 1 second while I'm learning with you guys on how to do this. Okay. So next week, notice the IV has increased. Why did it increase? Because there are earnings reports. This will, I would say 100%, but I don't know if it's for sure 100%. But I would say, 10 times out of 10, your IV for a call or a put is going to increase substantially that week, which means you're going to pay a higher premium. So Corey says holding calls through earnings is a no-no. That's up to you and your investment strategy. Let's look at that, I guess, with the IV. But let me just kind of finish real quick. What's called an IV crush is after the day of the earnings, this percentage will go down, meaning these premiums will also go down. Now, what's the actual percentage? It's a little bit more of a complex math equation to plug in. I haven't really found a calculator that can correctly identify what it is, because, again, the IV formula, it's not just, okay, it doesn't look at delta, it doesn't look at theta, it doesn't look at the time value, for the most part. It looks at how much this stock can change. Okay. So when you're looking at this, depending on how the earnings go, if you're in the wrong direction, you're going to lose money anyways. It's just when people buy these options on the same day, even though the stock went up, what really helps is just knowing your break-even point. So the question is going to be this. If you bought this call to buy it at $43 and past earnings, what's your break-even point? So this is for Corey. So if your bid was $3.60, the call was 43, what's your break-even? Just to make sure you make money, you have to add $46.60. Now, can that happen? Oh, of course. Of course it can happen. Could it not? Oh, of course. Can definitely not happen. Then you're out of money because it's going to not be worth anything. Well, by that I mean it's not going to be as much, because when when you buy a call during earnings and it goes against you, you're facing a lot of different things. You're facing your theta, so you're going to lose money off of that the next day. Your delta, because if let's just say the earnings go down or the stock goes down, you've got your theta that you're losing. Your delta, because remember each dollar it's going to lose $55. Then your IV is also going to go down, the percentage, which means these premiums may just be like $1.70. This may be $1.80. This may be $1.90. Okay, and I'll go into what bid, midpoint, and ask is. But
he did ask. Do you? Corey did ask. Do you want to hold calls through earnings? Yes or no?
If you have a not just a gut feeling, if you've done your due diligence, if you've researched the company and you truly believe it's going to pass your break-even point, then that can answer your question. I
can also not answer your question because, for example,
I personally do not.
Yes, for example, this week, Rocket Companies or Rocket Mortgage, they did about 4 times their earnings. The stock should have shot up, but it did not. So that hurt a lot of us because we had calls on that we were holding through the earnings.
Oh, that's so weird. And this side note to Connor, I drew these a while ago. Look at that. These are those zones that I was telling you about.
Oh, yeah.
Interesting. So I F for respects. So I personally don't do it. And I did Pinterest. I did a couple of them. I was fortunate. I just felt because of the coronavirus and a lot of people, looking through all that stuff. I also did do Twitter as well, so I took a hit on that, thinking that more people were on Twitter.
Yeah.
But when you do these earnings plays, is what I call them, as earnings plays, it's a risky thing because again, it's a 33% chance to win by expiration date. And what I mean by that is if earnings go up for this NEO, let's say it hits $45, it still needs to hit $46.60 to break even. But you have what's called time value. So the next day, if NEO's earnings go up, yeah, this will likely go up. Likely. The IV crush will kill you. I can't give you an example because I don't have a picture of what. Well, actually, you know what? It would take too long. I don't want to confuse people. Let me real quick go over the put just so you can see the difference, because there is one little subtle difference with the put. So again, this is NEO. Now you're looking. The only thing that's different with this is, again, this is a put, so this is the right to sell. So I want to do the right to sell at $43. NEO's at $43.08. Since this is a right to sell in terms of what's called in the money, you're not in the money. It's opposite. Because what would happen if you're in the money is if this stock price goes down, because you want the stock price to go down because you want to sell it at 43. The call is opposite. It's considered in the money for a call if things go past it upwards. Okay. Now, the only thing that's different is the delta is negative, and I don't know why they put it like this, but it essentially means the same thing. I'm sorry, it doesn't mean the same thing. I corrected myself. So again, delta is the change for every time a stock goes up $1. So it's inversed. So if the stock drops from $43 to $42 for NEO, it's not negative $45. It would be minus 45. Okay. So basically what this means is for every dollar it goes up, it goes down $45. But for every dollar it goes down, it goes up $45.
Aaron did ask if it hits 47, is that in the money or no? Because less than 50 cents
Yes.
is the money.
In terms of just the contract spec, anything past $43.01 is considered in the money. It's just you have to look at your premium. So when you look at your premium, that's like your own internal, like, am I in the money? But when you're looking at in terms of what the market sees, what a broker sees, and how the contract specifications is seen, anything past 1 cent is considered in the money if we're looking at a call.
If we're looking at a call, and then it's opposite for the put.
It's opposite if it's a put. So if this stock rises to $47, yeah, you're kind of out of luck on this one if you bought this put. Okay. Now, I think I kind of covered all the basics. Time value, this is telling you that it's not a price. I don't want to confuse a lot of people. I'd rather just have you think about just realistic expectations. Okay. So I'm just going to show you just a couple examples with NEO, how things look. Okay. And then we can go over any questions with that. Now, with calls and puts, the further you go out from your expiration date, so that's so that contract can last. You can even get ones out to 2023. So if you are super bullish, if you think NEO is going to be the next Tesla, and you think it's going to go past 420 to the moon, all the memes you want to throw at it. Let me go to the calls. Okay, so if you look, I want the right to buy NEO at $45, but look at what your bid price is, 18.6. So you're basically paying $1,860 for a $45 right to buy. So you're in terms of the very end. So we're talking January 20th, 2023. To technically be in the money, you would add the $45 plus your bid price or the price you executed at. So that would be what? So 58, 53, so $53. I'm sorry, $63.60. So you have to hope that it goes past that. Okay. And then look at what the delta is too, which is nice over time. This may be a good play if you're bullish on NEO. If you want to put out roughly $1,900 and let it ride. Now, if NEO goes to like $400, this option, this is going to be worth a lot of money, a lot of money. Now, but that's also 3 years of holding this contract. So, and the IV is still high. This percentage will change. This is just the direction of the percentage of how the stock can move up or down. But look at the theta, 0.011. So technically, if I were to buy this at $18.60 for right now at $45, it's only going to go down $1. So if NEO keeps going up, look what overlaps it. If NEO goes up $2 over in the market, $71, so 71 times 2, so $142. That trumps the theta of $1. So this call will go up. Okay. So the sooner you get, or the closer to your expiration, the cheaper it's going to be. Okay. The further you go out, even if it's $45, it's still going to be more expensive, whether it's a call or a put. Oops. Okay. Are there any questions with that?
No, Ken had answered one.
Okay.
But when it comes down to it, what, like the big thing is people that are just starting out, you have to kind of become familiar with options. Mm-hmm. I don't recommend going out there and selling any options right off the bat.
No. That's okay. Let me actually talk about placing these orders. Okay. I'm using Schwab. I'll show how you do it on 2 other ones. Okay. The only 2 for the longest time, no one has permission from me. Okay. I mean, if you want to, you can, but no one has permission from me to click buy to open. I'm sorry, buy to close or sell to open. No one can ever do those two. Okay? Buy open, sell close. Think of it like a book. When you buy a book, you open it. If you go to Barnes & Noble, what are you done with the book? You've closed it, you're done with it, you sell it. When you buy a book, do you close it? No, you open it. When you sell a book, do you open it? I mean, I guess if you're technically going to show them the book, sure. But just think of it like when you're thinking of a book. When you buy a book, you open it. When you're done with the book, you sell it, unless you read it again. But, don't give me those little smart, remarks. You sell it to close the book. Okay? What do those other two mean? Those are if you are a contract writer and you are shorting, okay, or writing the options. I'm not going to show you how to do those because those are what's called unlimited losses. Okay? When you buy to open or sell to close, you only put out the money you paid, the bid. Okay? I'm not going to go any further, and if you really want to know more about that, you can PM me or DM me on Facebook, and I'll go over what that does. But if you click these two, and I've seen someone do it about Tesla. I don't know who it was. I don't know the name, but I immediately told him what to do. Luckily, he made money off it, I think. Okay? But these are unlimited losses if you select these. So be very, very careful. Okay? Now you may think, okay, but does Schwab has this. Do others have it? With Robinhood, I don't know. I've never used Robinhood for trading. I don't know. But with TD Ameritrade, they do. And I'm just pulling something up just so you can see.
So what's the safest, what's the easiest option to do for somebody just starting out?
Okay, just starting out. Oh boy. I would say if you really want to just,
and you don't even have to pick something specific, just say.
Right. If you really, I would just say, oh boy. I mean, that means I'm giving advice.
Well, yeah.
Okay. I personally, I would do options on companies that I understand. And by understand, I mean the companies where I know their financials, where they've been. New companies, that's super risky. Okay. Now, yeah, you could be right. And you may think, oh my gosh, I'm really good at this. And I've seen people do this before. They've made $100,000. Not me. There's someone I know. Made a lot of money. They think, man, I'm really good at this on a new company. Put all that money into another new company on calls or puts. It was calls. Lost almost all of their money. That sucks. And I'll say that. That really sucks. Because that could have been a down payment for a house. Could have been a new car. Could have been a diamond ring for a fiance. Whatever you want to, put for. So with new companies, I would really caution you on doing that. You can do whatever you want. The only thing I told, Mr. Math or Dr. Math, however you want to call me, or Chris, I forbid you to click on the buy to close or sell to open. Those are the only two things. You can do whatever you want. But when you're dealing with new companies, it's very risky because we know them privately, but then when we talk about, they have more reporting, things like that, disclose. Okay.
Yeah. And kind of what I was getting at mostly is like, look at buying calls or buying puts, not selling. Obviously if you think something's going to go up, buy a call. If you think something's going to go down, buy a put. That's just kind of the easy way to think about layman's terms.
So that's what I don't do that. Other people do. So anyways, looking at that, trying to think okay, so in regards to placing the trade, let me just go over that real quick. let's just say I'm going to buy Neo, and I'm going to do next week. I'm thinking, yeah, Neo's going to shoot up, to the moon, not even to the moon, to Mars. Watch out, Tesla. Okay. So if I want to buy this call tomorrow, okay, you have what's called a bid. There is a midpoint and there's an ask. Okay. Bid and ask should be familiar to a lot of you, but let me just go over again. Bid means what the current price is that someone will pay to buy it. Ask is the current price someone will sell it for. The midpoint is literally the difference between them. So it's like an average. $3.65 plus $3.55 divided by 2 is $3.60. Now, that's a really easy one to look at. Now, why is there a midpoint? With market makers and other trading algos, and it's generally computers, they will fill the midpoint more often than not, depending on the spread. By spread, I mean the difference between the bid and the ask. Okay, so if I put my bid for $3.55, it may not fill right away. If the stock starts to go downwards, so that means it's affected by the delta, this ask price will go down. The midpoint will go down, and then the bid will go down, which essentially it will fill for that $3.55 or $355. However, a lot of market makers and trading algos, if they see on their level 2 data, which that if they just see someone putting a bid up, so let's say it's like a car auction. The current bid's at $3.55. Someone else jumps in, hey, I'll buy it for $3.60, even though the person that's auctioning the car just really wants to sell it for this amount, $3.65. It may fill. Actually, I would say 80% of the time it will fill. Okay. So so that's what the midpoint is. Some brokers will show the midpoint, others don't. So you have to be careful. So if I were to place an order, so I'm going to do Schwab first. Let's just say, okay, I want to buy this. I'm doing a put. Let's do a call. And I want to buy Neo I want to buy a contract, so 100 shares. $43 is the purchase price for my contract, but I'm going to pay the midpoint. Okay. So in this, some of this may look wonky, but I'm going to click buy to open. Remember a book. When you buy a book, you open the book because you're going to read it. Quantity, be very careful because some people can mix quantity and the price. So if I type, well, if it was an even number, if I typed 5, when in reality I meant to do something else, you're going to buy 5 of them. So be very careful. So I'm going to buy 1. And then always do limit orders unless you really, I don't even know when. I would say, I would just say, I would say limit, because then you'll get the price. Because when you select market order, and this goes for all platforms, whether it's Robinhood, Webull, anything, market will send an instant whatever this ask price is if you're buying. Okay, so if I select market and I buy to open, it will fill at $3.70 instantly. That means I could have gotten it for $10 cheaper. For me, I'm a penny pincher. That $10, that's a lot to me. Midpoint, yeah, I'll do that. Okay. Now, if you sell the close, and you click market, you'll sell it at the bid price. So whenever you select market, it will do either, if you're buying it, it will do the highest price. If you're selling it, it will do the lowest price. It's kind of like when you trade your car into a dealership, you get the lowest value. Okay. When you buy, so think about it also the same analogy. When you buy a car at a car lot, you're paying more money roughly. But then if you buy it private party, or if you sell your car to a dealership, you get a lower value, okay, from the market. So limit, you can click, or for Schwab, you can click it, but you can input your limit price. Excuse me. There's a question. Is there a way to estimate what your option contract at a given price if the stock, like when pre-market is up or down? Okay. The Greek. Okay. So options do not change until market is open. Because option contracts are only traded during normal market hours. So some programs or some brokers have programs built into their trading the trading program that will change the prices for you. Some can do what's called a theoretical option. So pre-market, if it's up or down, more often than not, I don't usually see them change. What will happen is tomorrow at 2 a.m., these will likely erase to zero. It just depends on the stock. Sometimes they. Can you guys hear me?
Yes. Yeah.
Okay. Sometimes the options will erase to zero. Others will automatically kind of pre-fill depending on the program. I hope that answered your question. Otherwise, if not, just look at your delta and your theta to get an idea. Deltas do change because I would even say be patient and see it on open. But you can still mathematically determine what it is. If you bought this NEO contract for $3.65 or $365, NEO hit 50, do the math. I like the math. Okay? Oops. So if it was 365, let's say NEO hit 50. Okay? Delta will change because then you talk about Vega and Rho because it's a derivative on a derivative or an integral. I forget which one it really goes into. Because it's like what changes from that change Because the further you get in the money, because notice when you look at these deltas, this is the call. So you're in the money if the contract is lower. Okay. Yeah, you can use the delta to see what it's worth. So if it's 365 that you purchased it for, your theta is, I'm just going to round it, is 0.8, but your delta is 0.5. Let's just say it's 0.5, and it went up $7. So 5 times 7 is $3.50. So let's just do some quick math. You roughly know this option is going to be worth $7 per contract or $700. You can use the delta to see what it's worth. It's rough though, because you also look into because this delta has another math formula. All these are formulas. So the delta is then determined by another formula, which, and again, I could get them flipped, which I believe it's your Rho or your Vega, and then that number is then determined by either the Rho or the Vega. It all just kind of landslides with each other. Okay. Do you guys want to see how to place an option order on E-Trade? Does anyone use E-Trade? Witchcraft category. Yes. Okay.
Someone asked for Weeble, and I think we're going a little bit late. Where I'm not sure if we should keep going or if there's people that probably want maybe, and we can continue as far as for next week. But I think we got a lot of the good basics down. Was there anyone else that had other questions or want to see another platform or needed clarification on stuff that we just went over? Appreciate. How should I pick up price?
Okay. So I'll give you this scenario. Okay, I'm not going to use NEO because a lot of people are. I'm not saying that. I'm just saying a lot of people are thinking it's going to go up because of all the hype that's going on. But let's just do let's do AT&T. That's my favorite stock to look at. Not advice. Okay. When I look at AT&T, AT&T is what's classified as a defensive stock, meaning it generally doesn't change unless something extraordinary is happening. Maybe like aliens were discovered by AT&T, things like, just whatever. But when I look at my strike price, let's just think about this. Let's just say AT&T. So I'm going to look at a call for November 20th, 2020. I know my AT&T range. This just tells you for the day. Let's just say my 52-week, the high for AT&T was $33. The low for AT&T was $27. Okay? So think about this. Do I really want to buy a call to the right to buy AT&T at $38 if I know the high of it was $33, the low is $27, and right now it's at $28? That doesn't make sense. The only time that would make sense is if you know something that a lot of people don't know. Maybe AT&T has 6G already deployed, but no one knows it. Something that would just make this stock rise exponentially, I would say, or substantially. Okay. Would I want to buy a call that may be in the money or at the money? Yeah, that makes sense. So if I chose maybe around here, $28 to $29, because right now AT&T is at $28.73. Yeah, that would make sense. Could AT&T in a week go up to? So if I bought this for 29, or the right to buy at 29, my bid was 22. My midpoint's 0.23. My ask is 0.24. So the spread is very, very low, meaning if I select the midpoint, it will likely get filled. So let's just use midpoint for an example. So could it pass $29.23? So could it technically go past 50 cents? Yeah, that's very possible. Could it go up $4? Sure. Let's just say that. Maybe in your dreams. No, but it likely will not. So when you're looking at what a proper strike price is, you have to look at three things. What's your break even? What's the realistic time frame? So this is November 20th. Okay. So in 9 days, can AT&T hit $38? Nah. That's why it's literally $2 to buy, because it doesn't make sense. Sure, someone could buy a bunch of these calls. AT&T could blow up and they're millionaires. I've seen people do things, and they have made a lot of money off of them. Okay. Do I say you should do it? I would. I'm not saying this is advice or not advice, but just be more realistic in your things. Okay. So you have your break even, your strike price, and then your time value or your expiration date. What's realistic to you? So this is from MB. So if you look at NEO, going back to NEO. Oops. Oh, okay.
Yeah, that's a good question. That's in there. So because I do mine a little bit differently. But
okay. Oh, that is a good question. Why buy deep in the money? Okay. The further in the money a call or a put is, the more it will actually change, the quicker it will change, I guess the best way to say it. So let's just say, this is hypothetical. Let's say NEO is continuing to go up for the next 9 days. It may be more advantageous to purchase this call, this $37 at $7, because look, what's your break even point? 37 plus, I'm just rounding, plus 7 is what? $44. So, but here's the risk. You're putting more money out to make more money though. So you have to make sure. Because your break even, so this technically just needs to go up $1, which without even seeing the extended hours, it's $43.54. So if you bought this right before close, this is what it closed at, $7.03 or $6.90. When you look at your call prices, I forgot to mention this, brokers will show you the midpoint value of the call or the put for your price. So also notice the theta is lower, the delta is higher. So in terms of your risk, you have to determine what do you want to do? Do you want, if NEO were to go up to $50, this call will be worth more than what this call would be of $43. Why? Because the delta is roughly $25 difference per dollar. Per dollar the stock rises. But here's the problem though. If NEO drops, and this is 37, you're going to lose more money. Excuse me. You're going to lose more money though. So it depends on your risk management and how much money you want to put out for a specific option. If that answers your question. Cool. I'm trying to think. Those are more of the basics, and I went a little bit further into more intermediate. I'm just trying to think if anyone else has any other questions or thoughts. You know, there's not a bad question or thought.
Yeah, and if you do have questions, feel free to message Ken, Chris, or I, or anybody else that's on kind of the team, because we're always open and we're always willing to help for sure.
Yeah, definitely. I would say if you buy, these are, I just go by some rules, some of my rules. When you're trading options, is have a stop loss. So if something were to go down past maybe 20-25%, I would maybe get out unless the strike price is, I'm sorry, if the time is way out there. Like a good example was I bought a Netflix call on market open on Monday. I was up $200. So I was technically up 15%. I chose to hold it, and then I took an actual loss of 20% because my rules for day trading are take 20%, if it were to go further down past that, like once it hits 20%, watch it. If it goes below 20%, immediate sell. And I say weak hands or green hands, meaning I'd rather take a small win than a large loss. If you go below 20%, oh, they don't have, oh, okay. So with Robinhood, I mean, most brokers have almost $0 in commissions. Options do have a commission though. I know a lot of stocks, you know, it's zero commissions. It's roughly, depending on your broker, between 50 cents to $1. To both buy and to close. So you roughly pay $1 to $2 for the whole transaction, and that's per contract. Yeah, you can place a sell order or a limit order to sell. The thing with, and this is with weeklies, and by weeklies I mean if you buy an option that's expiring that week, I would watch it a little bit more closely because your theta is going to increase. When you look at options, this is just stuff that I've seen over time that a lot of people know. Once it approaches the 1 month towards expiration, so if I bought NEO and I looked at maybe a February call, that theta is not going to be, it's not going to decay as much. So it may decay $1 for 1 week, maybe $2, but then it's going to slowly, it's going to double up, or it's going to exponentially gain. So if I bought a Neo call today and then now it's January, that theta is going to go up, meaning each day I hold on to it, unless it's still going up, you're still making money. Okay? Because the way that theta works is that's the decay of the option, but when the option gets further in the money, meaning it's worth it, it's worth it to exercise the contract, that theta is going to decrease, delta will increase if you're going the right way. If you're going the wrong way, that's not good.
Absolutely. Cool. I think we covered a lot. So, and that was almost an hour and a half, hour and 45 minutes. So
that's totally fine with me. So I like this stuff. So yeah.
I think this is a good place for us to kind of stop off, and maybe what we can do is build upon, what we've already discussed. I think this was a foundation where we kind of covered the Greeks, we covered as far as a call, a put. Maybe we can go a little bit more in depth on the platforms, things that you look for. I'll share things that I look for. We got Dan on here. I'm sure he wouldn't mind sharing some of the stuff he does. This case, it's like it gives you guys as far as a repertoire of ideas on how to kind of shop for your strategy, because there's various different strategies. There's not one all be all. I think there's definitely rules of thumbs and it's really comes down to risk management and understanding what you're doing and getting into. I think that's what it really comes down to. But in this case, if we can be able to show you a few of the things that we do, maybe next week or another time that's convenient, we certainly can do that and share just our best practices, if you will.
But I do have to say, as a disclosure, no advice. We lose money too. It happens. Not every trade is perfect. In options, you have a much higher risk of losing more money. So just be weary of that. So the risk management thing is very important.
Cool. Anyone with any questions at this point? Alrighty, so this call was recorded. I know that some people came at different times, had to come and go. We'll send this out. We'll probably post a link and have it downloaded or uploaded to YouTube or some other platform so that others can be able to view it. If you have questions, feel free to reach out to myself or Chris or Dan. Some of the guys that kind of have a little bit more experience. We're happy to help you out. Or even the other moderators can point you guys to us or answer your questions to the best of their abilities. But we certainly appreciate your guys' support in joining us today. By all means, if you guys can support us more, the best way to do it is by inviting people to the group. We're looking to grow it. Like us on Facebook, our PersonaFi page. We're still working on it. We're working on the iOS versions, should have it soon. It will include options. This case, you can be able to, right at your fingertips, you can see what other people are doing instantly. You don't have to go through the back and forth and messaging them. I have a few people in here that message me, and it sucks because I'm like, dude, I totally forgot to tell you that I just sell it, and then oops, 80% down. So it sucks, but this will solve that problem. You can go through people's portfolios instantly. It really makes things easy. But once again, thank you guys. We'll plan for stock picks at 6 next week. I'll keep you posted as far as what we do, whether it's a build upon this or we have to do it a following week. But once again, thanks, Chris.
Thank you.
Yeah, no problem. I'm here to help. I work 24/7, and I think Connor can attest to that too. I showed him some stuff late last night, but with day trading, it's 24/7 trading, or I guess 24/6 trading. So you'll probably see me, if you message me, even like at 3 a.m. in the morning, I'm probably up. If not, I'll answer it. I'm very, very quick because I work from home and I'm on the computer. So again, if you have any questions, just send me a message or DM me, and I'm more than happy to help. So thank you again, guys, for having me. I do appreciate it.
Thank you, Chris.
Thank you.